is the weekly market wrap-up. I want to start off by saying thank you to everyone who emailed in. We really appreciated the feedback, and I want to give a special thank you to JB. Your kind words were very much appreciated, and I'm really glad that you decided to stick around. Starting off in the equity sector, the mood has changed a little bit from last week as we saw a slight pullback in the major indices. The S&P 500 took the biggest loss, but the uptrend is still very much in play, even though there has been a recent announcement from a Federal Reserve official that the central bank could start letting off from loose monetary policies. Now, even though it is great news that all three major indices are up to the year to date, we're going to be cautious and cover some data metrics that are particularly worrisome. First, manufacturing activity in the Mid-Atlantic region has decreased even despite a marketing campaign that was strongly promoting business in that area. Second, U.S. housing starts plummeted in April, even shortly after mainstream financial publications were persuading the return of the real estate bull market. Finally, new claims for jobless benefits unexpectedly jumped last week. This clearly confirms the fragile state of American employment trends. In order to move away from all that disappointing info, there is a fair assumption here that we can make. If the Fed does indeed pull the plug on QE, the US dollar valuation should rise significantly. This would put added pressure on the Japanese yen and a recently declining euro currency. If we take a look at the technical chart, the dollar index has clearly broken past the downtrend line. And while we experienced some volatility on Thursday, momentum is still in favor of the bulls, but only if the index doesn't fall beneath the 82.25 level. Now, if you're an investor who is a little bit worried about the diminishing opportunities in the equities market, you may want to consider initiating a long position on the dollar-yen pair, where the central banks of the two nations have a divided view towards monetary policies. For this currency trade, the next logical target is the 110 level, and as Japanese investors look to foreign assets for higher yields, it appears this target could be reached sooner rather than later. Okay, over to my favorite part, winners and losers, and of course, starting with the winners. On the podium this week is Kabuto, who is up 11% from last Friday's session and has risen 38% so far in the year to date. This company was our top pick in an article posted several weeks ago on March 19th at futuremoneytrends.com. Another quick fact, at this same time, mainstream financial pundits were ignoring Kabuto, instead favoring the American giant Caterpillar based on conventional analysis. And guess what? Caterpillar is down 6% year to date.
If you look at where it's come from, you're talking about a $20 stock that went to almost $120 off the March 9 lows. That has all the hallmarks of a topping out, rolling over kind of situation. We're sellers.
A victim of the currency war that many investors fail to account for. See, people, you should listen to us. You know how they say 1 minute you're up and the next you're down? Advanced Micro Devices is a perfect example of this. AMD was our big winner just 2 weeks ago, and it's now on our losers list. Now, to be fair, a stock that goes up 60% year to date cannot be considered a true loser, but it did drop 12.5% on Thursday, which highlights the discipline an investor needs to be successful in this rapidly changing environment. Finally, let's take a look at precious metals, which has been sending some pretty mixed signals throughout this week. As expected, both gold and silver took a dive due to currency fluctuations. To get technical, gold appears to be forming a bullish double bottom reversal, although this would mean near-term volatility and a lot of nail finger biting. For silver, the metal appears to be bottoming out and away from any sign of bullish support. We really need to see higher moves from here, or the downside could be significant. However, once again on the positive side, palladium has been on a tear this week, closing Thursday's session at $734 and is now above both its 50 and 200-day moving averages. The upside is expected to continue, with Japanese demand and Russian short supplies catalyzing an already explosive market. And that wraps it up. Thanks again so much for joining us for this edition. I really want to hear from you guys, so please email me at info@viralnetworknews.com. But not before you subscribe to crushthestreets.com and Viral Network News. For VNN, I'm Hannah Bernard.